back, class. This is chapter 15, raising capital. We're talking about how firms actually go into the market and raise their capital. Basically, the early parts of a business cycle, you're in venture capital territory where businesses are basically starting up and they're presenting ideas to potential investors. The investors may like or not like their idea. In fact, most of the time in venture capitalist, where you're seeking venture capitalist funding, you're going to be rejected. There's a lot of people seeking this venture capital money. So if you do this, and if you're looking for somebody to actually help you start a business, you need to consider these factors. How strong are they financially? What is their management style? Are they going to be involved in your business every day, or are they going to be monthly summary type folks? How have they behaved in the past? And what kind of contacts do they have in the business? And also, what's their exit strategy from your business? Well, another way of raising capital is selling securities to the market. And if you're going to do that, if you're going public, as they say, you need to register with the SEC. And this is a big process involving a lot of financial information and history of the firm. When you do this, the Securities Exchange Commission is going to look at your company to make sure it's solvent, look at the financial information, basically looking at what you're doing, how you earn your money, and that kind of thing. The SEC came about in the 1930s as a result of the Great Depression. As you recall, the market collapsed in October of 1929. When that collapse occurred, many of these firms that have been selling securities in the market were found out that they didn't really have the value they said they had. Therefore, there was a major collapse in the market. The market was way overpriced, and so you saw a lot of losses at that point in time. When we look at the market and we think about this, what we are looking at is basically how do we make sure that that company going public is going to be solvent, and what are they going to provide us with in order to help understand what they're going to do and where they've been. The registration statement contains a lot of that information, and many companies put that into this thing called a prospectus, which is like a booklet full of financial information, history of the business, and things like that. And the prospectus is going to contain a lot of the information from that Securities Exchange Commission application, but it's also a form of advertising, and they put usually what they call a red herring here because they put in red letters on the cover of the prospectus what this firm is offering or what this company is going to be offering. So the company can't sell securities until they actually have approval from the SEC. But underwriters who are preparing the process can go ahead and advertise the coming shares of stock, as they did here. This is called a tombstone advertisement. Basically, it's to grab the attention of potential investors. They talk about what they're going to be doing, how many shares they're going to be issuing in the U.S., how many they're going to issue internationally. And this group here of underwriters is what they would call a syndicate, where you form together to spread out the risk of this initial public offering. So there are other ways of issuing funds or issuing securities to raise money in the market. If you have a small issue, fewer than 35 investors, you could call that a private sale. And in that case, you wouldn't have to register with the SEC. But anyway, that's an option. That's an option. The public issues are generally a general cash offer and a rights offer. If you're doing a general cash offer, you're just selling the securities to the public on a first come, first serve. With a rights offer, you have some shares of stock reserved for existing owners. That is, assuming you've already issued shares in the market. However, if this is your first time in the market, you're an initial public offering, an IPO, and that's similar to what Facebook went through a couple of years ago. A seasoned equity offering, an SEO, is a new issue for a company with securities that have been issued before. So they may have existing stock in the market and want to put another class of stock out, or just simply issue additional shares. In that case, that's what a seasoned equity offering is. Here's a list of the different approaches or methods of issuing securities. Underwriters. Many underwriters are going to form together as syndicates to spread out the risk. And what do the underwriters do? Well, they're going to form this group, and they're going to help sell the issue of stock. What will happen in many cases, at least right now, is the firm commitment underwriting, where the underwriter will purchase all the shares of stock and then turn around and issue those to the general public. When we're looking at that, the underwriter will look at what can this be sold for. They're looking at the offering price and basically looking at large institution buyers to see what they think and negotiate that price. A second approach is best efforts underwriting, where the underwriter doesn't necessarily buy the shares of stock. In this firm commitment underwriting, they do. They buy the shares of stock and sell them to investors, and then the difference is their spread or their income. In a best efforts, they are bound to use their best efforts to sell the security, but they don't guarantee any particular amount of money to the issuer. This is not common at all. Firm commitments are the dominant approach. There's a third way to do this, and it's called a Dutch auction, and this is really where you have bids taken on the shares of stock. This is also called a uniform price auction. It's new. It's not been around very long, not widely used. It is used in the bond markets, but with Dutch auction underwriting, probably the most famous case was when Google decided to use that approach when they went public. And the best way to consider it, they have an example of it here. Because it's not very common, I'm not going to go into this right now. One of the things to think about is in many underwriting contracts, there's a green shoe provision. What that means is this relates to the aftermarket after the initial public offering. The underwriter will stabilize or support the market after the initial public offering for a short period of time. They will sell 115% of the issue. If the price rises in the aftermarket, they have this green shoe option to purchase additional shares, the 15% needed. If it declines, the underwriter will step in and buy the stock on the open market in order to support the price. And here they talk about the IPO of Facebook, where they had to stabilize the stock price. Even though the stock opened at a fairly good rate, it quickly fell in less than an hour after the trading began. And so one of the underwriters stepped in and began buying shares to create a floor so it wouldn't drop any further. They're not required by law, but these lockup agreements specify how long insiders must wait after an IPO before they can sell some or all of their stock. Lockup periods are fairly common in recent years, and the reason that this is because many insiders may have the benefit of inside knowledge and may be able to profit from that knowledge. A quiet period basically is 40 calendar days following an IPO. Basically what that means is that the firm and the managing underwriters are only communicating with the public through ordinary announcements and purely factual matters. They're not trying to sell this stock to the public. The SEC's logic here is that relevant information should be in the prospectus, and an important part of this is that underwriters, analysts are prohibited from making recommendations, so they can't go into the market and influence the purchase or acquisition of a certain security. IPOs do underprice many times. They underprice because they want to see the stock increase immediately in the aftermarket. They want initial purchasers to have a good gain. There's a lot of evidence for underpricing, and you'll see the history of it here. These are initial returns for SEC registered IPOs between 1960 and 2014. You'll see that there were peaks in here at different points in time where those IPOs where people profited significantly from those initial public offerings that they purchased, and that indicates there was some underpricing. And so these are the number of IPOs that were offered in those periods as well. Here's the first day returns, a table for that between 1960 and 2000. I mean, you'll see some peaks here where there's some high returns on the first day, like in 2000 there was this 56% return. Anyway, those are some questions that we need to think about when we're talking about underpricing. 1999 and 2000 were extraordinary periods for underpricing. You'll notice here in the book it talks about this large sum, which was a record amount raised through underpricing, and that really does sound like a lot. And when they talk about it, it was more than all of the underpricing increases between 1990 and 98. So that's a big amount related to the underpricing and profit coming from those initial public offerings. The IPO market has cooled off recently, and a lot of this has to do with tech companies who were going through an IPO in the 90s and early 2000. So a lot of those companies were in startup mode at that point. They're not anymore, so you don't see as much of that. Let's see here. Why does underpricing exist? Well, one of the obvious reasons is so that the initial shareholders can benefit from it, and also because it's more attractive to those purchasing shares in the initial market when they're able to take advantage of that. When we talk about new equity sales and the value of the firm, basically when we have an initial announcement of a new equity issue, sometimes they decline in value, the stock prices do, but they don't change much after like a debt announcement. So researchers have studied the issue. There are several possible explanations here, and they provide those for you. What are the costs of issuing a security? Well, first of all, the issuing company has to recognize that they're not going to be able to recover the full price of the equity shares they're issuing, that they need to cover the spread for the underwriter, that they have to be willing to take a discount on those shares as they enter the market. There can be a lot of direct expenses as well, attorney's fees, investment banker fees, and so on. Indirect expenses are things you don't see necessarily. Those would be costs of people working on the prospectus and things like that. Abnormal returns, where basically you have an unusual drop or increase in the share of the cost per share. Underpricing, this is a big cost for firms. They're giving up some of the money they could raise in order to sell the stock on the market, and that also allows the underwriter to profit. And then the green shoe option, if they have that, the underwriter can come back and purchase additional shares. Okay. These are direct and indirect costs in IPOs, and they show those here. You can look at those and the cost spreads and so on. So when we issue long-term debt, it's going to be a little bit different than when we issue shares of stock. Long-term debt will be basically things like bonds. Well, that's really what it's going to be, bonds. When we go into, if we're going to borrow money with a business, we may do it privately. But if we go into the public markets, we're going to do a bond issue, and those are going to be regulated through the Securities Exchange Commission. And again, this whole idea of regulating these transactions are to protect the public's interest from people who might otherwise take advantage of them. So they're going to make sure that these bond issues are legitimate, and that they basically have the required documentation in order to go into the market. With the shelf registration, what you're doing essentially is you're announcing you're going to issue this security. It can either be a debt or equity instrument. And then what you're going to do is you're going to wait. You're basically going to put it on the shelf after the registration. Now, this can be done, and it's allowed. There's a rule that's in place. It's been in place since the 1980s to allow it. But it offers the opportunity for a business to announce this issue and wait up to 2 years before it actually does issue it. Not all companies can do this. The investments that they're going to issue must be rated as investment grade. They can't have defaulted on debt in the past 3 years, and the aggregate market value of the firm's stock must not be more than $150 million, and the firm must not have had a violation of the SEC Act of 1934 in the last 3 years. The rule's been controversial. Many people have reacted to it differently. In some cases, they argue that the cost of new issues will go up because underwriters might not be able to provide as much current information to potential investors as they would if it were issued immediately. So investors may pay less, and the expense of selling would therefore go up. And some investment bankers have argued that shelf registration causes a market overhang that depresses market prices. And basically what it means is that the company could increase the supply of stock at any time. It might have a negative impact on the current stock price. So there's little evidence to support that, but that's one of the arguments. And they may also offer continuous equity offerings, what they call dribble programs. The company registers the stock through a variety of different methods and sells the shares in dribbles as they see fit. In other words, they don't sell the securities all at once. So that's really it for Chapter 15. When we're looking at Chapter 15, there's a couple of questions that you need to look at, because you're going to write a short answer, a response to these critical thinking and concepts items in 15.1. Debt versus equity offering size. Debt offerings are more common than equity. Why? And then in 15-5, IPO pricing. The Zipcar IPO was underpriced by about 56%. Should Zipcar be upset at Goldman over its underpricing? And basically, the Zipcar case is presented up here in 15.4, where they talk about it. Zipcar, the car sharing company, went public, and then it goes into the details of that case. All right, then you go down to questions and problems. And in questions and problems, number 1, you're going to respond to this, is a question about IPO underpricing. They announced this, this initial public offering. You plan on buying 1,000 shares. If an issue is underpriced, it will be rationed and only half your order will be filled. If you could get 1,000 shares and 1,000 in Woods and 1,000 in McElroy, what would be your profit? What profit do you actually expect, and what principle have you illustrated? And number 3 is the next question that you're going to respond to, and this is basically calculating flotation costs. This is going to be what you would pay to actually issue shares of security, how much are you going to have? How many shares do you need to sell in order to cover these costs? Now, the previous problem is what it's referring to. This Zuri company is going to raise this much money to finance expansion, and they talk about the public offering the security they're issuing, and you're going to calculate what you need to sell in order to cover those flotation costs. Number 5 is the last one here, and you're going to calculate the flotation costs for another case, and that's really it for Chapter 15. I'll look forward to preparing the videos for Session 5 and look forward to seeing your work from Session 4. Have a great day.